Hey everyone, it is Richard Harris and my friend Scott Leese. We are here for the next episode of the Surf and Sales podcast. We are grateful, very grateful for this guest. We've gotten to know him a lot over the last few years. He's one of those people that you sort of see go through the sales and startup world and then come out the other side with I'll call it a massive exit, and then doesn't just sort of walk away, but he now gives it back, and he's a part of Emergence Capital. So Doug Landis, please welcome to the show. We're glad to have you.
Thanks, guys. Good to have you guys too, or good to participate or be whatever. Yeah. Good to be here. I will say this, because the reason why I got my brain wrapped around the axle there for a minute is because you said for a few years now, it's like, Richard, I was trying to remember back to when we first met. And I think it's been more than just a few years. So just want to correct you on that. I think it's been a handful.
Oh, it might be. Wow. I mean, that's true. It has been a handful of years. I'd forgotten about that since that first meeting we had down in Soma. So, well, thank you for joining us, because we know you're a busy guy. We know the VC world's a very busy world. But before we get into that, and I know we're going to talk about VCs specifically, where's Doug Landis from? Like, if you don't know, Doug was very instrumental at Box and growing them and helping them reach their amazing exit. He's now part of the VC culture with Emergence. But where was Doug before Box and before that? Like what was early Doug like?
Yeah. What's my own personal narrative? Is that the question?
Yeah.
Yeah, totally. Narrative is a big subject of mine right now. It's a hot topic. I actually grew up in Palo Alto. I'm a Bay Area kid, which is crazy enough, but I've lived all over the world: Singapore, Australia, Seattle, New York. Funny enough, when I came back to the Bay Area after going to college, I came back and I took a job at Oracle. So I've been out in the field selling products that were outside of typical software and SaaS. And so, when you change industries, you kind of have to go all the way down the bottom. So the irony is I was in the field doing huge deals with major retail brands, and I decided to get into technology because I grew up here. And so I came back to Oracle after already being out in the field for 4 years, and I had to become an SDR. It was awesome. And we had to make 100 calls a day. And I met some of my favorite people in the world during that time, whether it's with Erica Schultz, we used to sit next to each other. Bob Fratty and I sat next to each other from Slack. Gosh, the list of people who we collaborated with during that time as SDRs, Nancy Kammer from sales. I mean, like, just the list goes on and on and on. But we were pounding the phones, and we were worried that we were going to get fired if we didn't make 100 calls. So, arguably, I would say that's where I kind of like, I kind of sharpened my saw, if you will, in terms of how to build that velocity motion. Fortunately, I elevated rather quickly because I had already had so much sales experience. I left Oracle, started my own technology company, went through that process. It failed miserably, but raised capital, et cetera. So I started getting a crazy bug in the software world. So eventually I went to go work at Google. And my job at Google, after selling software, I realized that I got more fire in my belly from helping other people realize more of their own potential. I could sell. I love selling. I'm a salesperson at heart. I always will be. It's in my blood. It's in my DNA. But honestly, I like helping other salespeople excel. That to me is so much more interesting. And it's also more about being of service to other people versus being super selfish, which, being in sales can actually really drive you to being super selfish. So I went to go work for Google. I ran all their sales training and development. But the interesting thing was, for the first time, instead of being part of like L&D, we were actually part of sales. So I rolled up to Tim Armstrong at the time, who ran all Google sales. This was in the early days. I left after about a year and a half, largely because Google is an engineering-driven company, and they don't really give a shit about salespeople, or at least they didn't at the time. They do now. Clearly, they have to. Everybody does. But they were just like, dude, it's Google. You pick up the phone and say you're with Google, and you'll get a meeting, which is largely true. And I got a phone call from my friends over at Salesforce, and so I jumped ship and went over there and helped. So my good buddy Brian Breckenridge kind of built the first, him and Nate Bride built the first like onboarding program there. And I came in, took that and exploded it to, was there for 5 years and went from 900 employees to, when I left, there was 16,000. They all came through our onboarding program, and we built everything from beyond that. So Box came. It's funny enough, I went to go present to Box on how Salesforce uses Salesforce, and the entire Box executive team was there, including Aaron. And afterwards, I had a little side conversation with him, and he's like, "Cool. So why don't you come work for us and do everything that you did there here?" And I had some friends that were over there too at the time.
How big was Box at that point? How big were they?
They were like 250 employees.
Okay.
Maybe.
They were established.
They were established. Aaron definitely was established, and their go-to-market was established. They had already pivoted from being the B2C solution like Dropbox was, and they had pivoted to be this B2B solution. But they had just maybe had their first couple of enterprise hires in place, and so it was still early, still super early. We had to figure out how to go tackle the enterprise and how to move everybody up market and how to transition people from roles to roles, which is really difficult. Most people forget about that. And you know, we were like a high profile, crazy tech company. And so I was there for 5 years through the IPO. And then, you know, the folks over at Emergence Capital came over and came knocking on the door. And the interesting thing about this domain and my role is, which is pretty unique. While I sit on the investment committee, I help us to source deals and due diligence on deals, say that 10 times fast. More specifically, I'm kind of like free go-to-market consulting for our portfolio companies. As you know, most of these early stage companies, because we invest in A's and B's, we just do B2B enterprise SaaS, which is also what allowed us as a firm to hire somebody like me to do this, because we're hyper-focused. We just do one thing really, 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 really well. I've done it really well. Zoom, Viva, Salesforce, we were the first investors, and Yammer and Box and ServiceMax and Steelbrick. Pretty good list. And so what's cool is I come in when you're $1 million and you're a product-led, you know, organization, and you don't really know the go-to-market side. You know, they've got a playbook of like, all right, here are all the things that you're going to have to tackle when you're trying to scale from $1 million to 10 to 50 to 100. And it covers the gamut on the go-to-market side. You name it, from hiring to messaging to pricing and packaging to comp plans, you know, tech stack, et cetera.
There's so many wins in that spiel that you just gave. I want to go back. I want to go back to the fuck up. I want to go back to when you said you tried to run your own technology company. I would like to know, you know, what you did wrong then that you'd presumably not make those mistakes now. So anybody who's thinking about going off on their own, what are a couple things that you screwed up? I think it's important for people to hear, like, even the great Doug Landis screwed up at one point in time and made it out the other side, right?
Yeah. By the way, I've had many screw ups, and I'll continue to have many screw ups. And if I don't, then I'm not living. So I'm okay with that. And I learned more in building that company than I could have ever imagined in an MBA or anything else. And the reality was, like, look, I think it was a combination of things. I think it was a combination of timing. So when we were going out and trying to raise capital, it was kind of the first .com bubble, if you will. And when we were going out and trying to raise capital, we were never able to show anybody that might give us money that we're going to give them a 10x return on their money. Because we built an exchange for nonprofit organizations to help them. It's kind of like a Match.com for nonprofits, to help them find funding sources from like trust, government agencies, large foundations, etc. So we're kind of that middleman. We make the match and help them kind of accelerate the process. And the problem is so the market that we were serving wasn't big enough for traditional venture capital. I didn't know shit about raising money at all. Fortunately, we had some friends and family money, and that gave us the opportunity to go raise a seed round. But largely, the product wasn't fully baked yet. The idea was baked, but the product wasn't built. And so I would say, like, figure out how to get the product built so you can test it. Because once you test it, it makes it a lot easier to go out and try and raise capital. But there's people who want to go start their own company. It's a chicken and the egg scenario, right? It's like, well, I need to raise money so I can go build the product. But then if I'm going to give you money, I want to kind of make sure that the product is there, which is also why if you've done this a few times, even if you failed a handful of times, you've learned, and you're going to learn from those mistakes, right? So get the product right, do your market analysis. I think that the things that we did well is we hired really great people. So I hired a former head of a foundation to be our CEO. He knew everyone, and he knew the language. so he could kind of direct us in that way. But we screwed up on the technology side all day, every day. It was terrible.
Just out of curiosity, because this is a long time ago. We're literally talking 20 years ago, right?
Yeah, totally.
You know, Scott.
I know, I'm old.
I think Scott was 6. But no, he was a little older than that. But what was a seed round back then? Because it's very different than today.
Oh, dude. I mean, 5 years ago, a seed round was like, what, 1 to maybe 3 million?
Right.
And now you get seed rounds of like 7
So
to 10.
I just want to give context to people that seed rounds back then is, as much as you hear about the original .com, you know, you're talking less than $1 million.
250 grand.
Exactly.
Yeah. 250. Our series A was like, so here's where I screwed up too. Here's the other thing. I got greedy. So right before the implosion of the .com craze, right? So we had raised $1 million. This is gonna be like our A late seed, whatever you're gonna call it. In our mind, it was like an A. And I thought we could raise more money, and I knew there was gonna be some shifts going on. So I was pushing for 2 because we thought we could get to 2. I had $1 million in the bank ready to go. And so when I started pushing for 2, that's when everything started to unravel. And then everybody that put their money in, because we hadn't cashed anything, so to speak, we hadn't cashed a check. We had basically signed term sheets, if you will. They all pulled out.
Oh man.
Everyone pulled out.
Dude.
This is like all I can think about is Bodie from Point Break just saying, go for the register, not the vault right now.
Right.
Yeah.
Yeah.
Love
That's
that.
hilarious. That's great. Cool.
Yeah, you can't. Even the way you try to raise now is very different. You could get away with raising back then with an idea. You can't really get away with that. Can't get away with it anymore. It's totally different.
Yeah. I agree. Although, look, I just heard yesterday that, you know, a former founder that's done it twice and had 2 exits has an idea, and, you know, got
someone's betting on him. Someone's betting on.
I totally agree, because he's done it before, right? So it's like a really interesting idea. Seemingly, I mean, you can quickly do a market assessment, like, wow, this is a massive market. Cool. I'm going to preempt everything, give you a $30 million Series A.
Yeah.
Right? Pre-product.
Wow.
Because I believe you can, because you have the formula, I believe you can do it again, and the market's there.
That's not the norm for everybody listening. That's not.
No, it is not the norm.
Yeah.
It's not.
How does one? What is the best way for one to evaluate who to take money from, who to partner with? Right? There's
totally.
horror stories all over the place about this org did this and got over on me and screwed me over here, and these people were great. But like, let's say, you know, you're just giving advice to any listener out there who might be thinking about this. Like, what are the top 3 things that somebody should look for in a partner beyond just the obvious of like, who's willing to write me a check?
Totally. Look, I will tell you, there's a lot of easy money out there. But easy money is not equivalent to good money.
Yeah, easy money is bad money. Yeah.
So the easy, good money to me is somebody that truly is bought into you. So here's 2 things that I've learned about the venture world as a non-traditional venture capitalist. The venture business is we're not in the finance business. We're not in the tech business. We're in the people business. So if I'm investing in your company and your idea, Scott, I'm investing in you, because I know over the course of the next 8 to 10 years, shit's going to go sideways. Yeah. Markets are going to change. We're going to have to pivot. And so I'm banking on your ability to hire the right people, to keep the ship focused on what we need to be focused on, to go out and capitalize on what's in front of us. And that's it. That's one thing. The second thing that I've learned in the venture world is it's so much predicated on flexibility. And so what I mean by that is like, to me, good money is a partner that understands you and that is able to be flexible with you when it may be time that we have to pivot or we have to change direction, right? It's also understanding, like, we're going to make some mistakes. We're going to. You're going to hire people that you thought were world-class and they totally shit the bed. So they weren't the right cultural fit.
How do I suss that out if I'm having these early conversations? Is it just literally like the transparency? Like, even the fact that you're telling me, hey, Scott, you're going to screw up. Okay. We're going to be flexible with you. Is that transparency and open willingness to have that dialogue key? Is that one of the ways to suss it out at the beginning?
I think, look, unfortunately, venture capitalists, when they're trying to sell themselves or their firm, they're in sales mode. right? Just think about it. They're in sales mode. And so I think the important thing is, just like if you're interviewing a sales candidate or a sales leader, to come work for you, you got to do your back channeling. You got to ask the real questions, like, what does partnership mean to you? Give me an example of where one of your companies was, a red hot, poster child and then really struggled. What did you do to help them? What specific resources can I leverage from you that can help me to fill in the areas that I'm weak, right? Because as a CEO, you're not going to be an expert in everything. And you're largely going to lean, either you're going to be on the people side, you're going to be on the finance side, you're going to be on the product side, you're going to be on the go-to-market side. And so you want to be able to have a partner there that that you can lean on to help you fill in some of those gaps, to help you recruit or interview, to help you think through, how to overcome some of the
so how do you
personal psychological challenges. I mean, there's so many things that come up. You just want, you want someone who's going to hold you accountable and challenge you, but also support you at the same time.
So how do you, I'm a 20-something person, right? Coming out, Stanford, right? And you've been down this road before. You know how to come in and answer these questions. How do I know that, the good VCs are good ones and the other ones who are full of shit? Because I'm willing to bet they all have to say the same stuff, right? Like, they do and they don't.
Look, the thing is, you have to go talk to people that they funded, right? So go talk to other companies that they funded, both companies that did exceptionally well and companies that maybe failed, and find out the level of support that you got from them. What did you do? How often did you talk? What kind of support did they offer you? What were the conversations like? What do they expect from you on a weekly, monthly, quarterly basis? What were your board meetings like? How proactive were they at reaching out to you versus reactive? Because there are a lot of venture capitalists that'll just write a check and they just go to board meetings and they just poke holes and shit, right? They don't really add a whole lot of value. And so to me, if I were starting a company, it's like, all right, who can help me? Who can add the most value to where I am right now? Right.
What do you think about, in my experience, there's two different types of founders. There's the founder who keeps the executive team outside of the boardroom and away from the board and the venture group. And then there's the founder or founding team that is inclusive and invites the executives into those meetings and those conversations and has that kind of builds that kind of relationship, right?
Yep.
Is that typical? That's been my experience. I wonder if that's a typical experience and what kind of alarm bells or red flags that might signal for folks.
So, it's interesting. I don't sit on many boards largely because, and sorry, I was looking up something I wrote down on my notes, but I don't sit on boards largely because I get so in the weeds and I probably know more about the business than the board knows about the business.
Yeah.
Right. So it's dangerous for me to be on the board because I'm not going to let you get away with painting this rosy picture of like unicorns and rainbows and be like, yeah, that's bullshit. You don't have enough lead coverage and you haven't done enough capacity planning. And if we don't fix these holes, we don't fill these gaps, you're gonna have a real problem. And so I think it's really, really important to be inclusive of the executive team. One, to give the executive team an opportunity to up-level their skills, because presenting in front of a board is a different conversation than just presenting to your peers on the executive team. And secondarily, too, I also the board's only job is the only thing we can really do is hire and fire the CEO. That's the only thing we can really do. I can't, again, Scott, let's say you're the CEO. I can't say, Scott, you need to go fire Richard because I don't think he's cutting it. I don't think he's the right person for the role. I could say that to you, but it's totally your call. You can do whatever you want.
Yeah, I was going to say bullshit because Scott's done that, but no, he's had to.
Right. But so at the end of the day, as far as the board goes, the board wants real information. I think the challenge with most board meetings is you send out a board deck, and then all you do at the board meeting is you go over the deck that everyone was supposed to look at beforehand. And what I personally think is really powerful in board meetings is read the deck ahead of time. Come to the table with a list of questions that you have that you need clarification on, that you need intel on, and then have a conversation with the CEO, and then get the CEO out of the room. Bring in the individuals on their own without the CEO, because I tell you what, my boss is sitting there, or my boss's boss is sitting there, and I'm trying to present the numbers. I am going to be so nervous not only because I'm presenting in front of the board, but also my boss is there. And it's going to be harder for me to answer the tough questions that they may ask.
I can tell you from personal experience being in the boardroom and getting asked questions, and the CEO's sitting right next to me, and I'm trying to figure out the right way to phrase or frame something that makes sure that I'm taking accountability, right? And also doesn't deflect responsibility at all, doesn't make the CEO look bad. It's tough for sure. You get sweaty palms.
I once saw Kevin O'Leary speak, the guy from Shark Tank, and he said before he ever talks to a CEO of a company that he's going to buy, he actually takes the best or longest tenured sales rep out to dinner, because that person knows where all the bodies are buried. They know exactly what the revenue machine looks like, how good it is, and how bad it is, which I think stems to this exact same conversation of how to be able to do this, respectfully, but also do it, directly, right, without having to put all this pretense on it. So
totally agree with that. I think the other thing about that is, I want, if you want to create a space where we'll call it radical candor, if you want to create a space where everyone's being really honest and they're taking responsibility for their part in it, or at least you get to see if they're the kind of person, the kind of leader that will take responsibility for their function or their department, that's a great opportunity to do that. I also believe too, and this is just on board meetings, and Gordon, one of our founders or co-founders, and I have talked at great length about this, but you also need to be really clear about what kind of board meeting is this going to be. Is this going to be a tactical board meeting? We're going to get super in the weeds and pick at conversion ratios. Is this going to be a strategic board meeting? We're going to talk about making some short-term strategic decisions like acquisitions or key hires we need to make, or up-leveling certain positions? Or is this a big picture, long-term, 5-year plan, let's think outside the box kind of session where we want to think where do we want to be in 5 years and what do we think it's going to take to get there? And I think the problem is a lot of board meetings are not clearly identified as far as what they're going to be. And so we just go through the same thing. That's my take. Again, not a prototypical venture capitalist.
Who should own defining that? Should that come from the board? Do you want to see it from the CEO? Should, if I can only assume that if someone like Doug was in my VC pocket, I'd be like, Doug, it's our first board meeting. Should it be am I showing them revenue? Am I talking strat? Help me, Doug. This goes back to what kind of do you get? You would be the first person I'd call if you were my go-to person.
I think largely it's a combination of it's a conversation with CEO and the board, right?
Is it okay if I'm a founder, right? And whether I'm 6 months in or 2 years in or 4 years in, is it okay for me to pick up the phone and say that to my VC? Because I could see at some point early on, you're like, I got to do it. But in 2 years, I've created some false belief system that I can't ask that question. I'll look stupid.
Totally.
PSA to the founder, by the way, don't notify your head of sales at 3:30 on Wednesday that you have to present at a board meeting on Thursday or Friday. True story. I've been there, had to do that. Yeah. Give them a heads up.
I totally agree with that.
But can a founder still feel like they should? I mean, I would hope they would, because that would be part of the relationship over the first year, the second year, the third year. But do you ever see founders who are like, wait a minute, why didn't you call me? I would have totally walked you through this, or I would have been, I'm happy to help you next time. Maybe you don't want to call them out. Do you still see that happening, or do people kind of figure this out by now?
No, I mean, I think if you're a first-time founder and this is your first board meeting, you're just going in there to give an update on the state of the business. And then at that meeting, you'll talk about going forward. What's our goal? How often are we going to do these? What do we do in these? What do you expect? What do you as board members need and expect from me? What do I want from you in all these meetings going forward? I think it's that conversation you say, well, listen, tell you what, once a quarter, we're going to have one entire board meeting that is just a pure strategic long-term discussion board meeting. We'll cover a couple of the logistical things, we have to agree on the minutes. We have to maybe agree on, options or whatever it may be, or our fundraising, plan. But then beyond that, we're going to no, this entire board meeting is going to be set for our 1-2 year goal. And then the next board, and then the next quarter, we'll set up aside one board meeting that's going to be for our longer 5-10 year goal. right? So it's up to you guys to kind of define the
figure out the
what
rhythm.
those meetings are like. Yeah, totally.
Have you ever, just out of curiosity, have you ever like, invested in someone and like, by the second board meeting, you're like, oh shit, this was not the right play? Or do you guys, and granted, you guys have learned.
You had buyer's remorse, buyer's remorse.
Yeah, totally. I'm going to say, look, again, I don't write checks. I don't sit on boards per se. So it's harder for me to say that. But I will say that overall, the answer will be no. And that is largely because we do so much due diligence leading up to actually, kind of transferring the funds, so to speak, that we know the organization, the people at the top really, really, really well. Now, does that mean that people can change? Like once they get the money's in the bank and all of a sudden they're like, you thought we were going in this direction and they're like, screw it, we're going this way. Sure, that certainly can happen. And I will tell you, as from what I understand, we have certainly, as a firm, replaced the CEO a time or two because it just wasn't a good fit anymore. Or there were some issues, or they had some personal issues, or they just capped out.
Right.
You realize, you know what? Like, yeah, you were the CEO to get us to 20, 30 million, but they're not really the CEO to take us public, as an example, right? And so, that's the conversation for the board and the executive team. But also, if the company continues to suffer, then someone has to take responsibility for it, right? And unfortunately, largely that's going to be the CEO.
What is the difference in the mindset, in your opinion, from somebody who's the, let's say the CEO who gets them from 0 to 60, so to speak, and then the next CEO who takes them from 100 to 200, whatever the numbers are, and that I think that is the same across disciplines. You know what I mean? Like, so I'm curious what you have found to be the differentiator in the mindset of those two types of executives or leaders, founders, CEOs, that type of thing.
So I'd say the CEOs that can go from 0 to 100 million IPO, start there, are a special breed because they are acutely aware of themselves and their own strengths and weaknesses, and they are committed to their own growth and their personal growth. And they're the ones that are going to hire coaches and therapists and leadership development strategists.
Invest in themselves.
They are doing everything they can to continue to grow and get better as a leader, right? Because they know growing from 0 to 100 and growing from 100 to a billion requires two different skill sets largely. When you're a private company, you have more freedom. You've got more room to test. As long as the board agrees, we're going to take some money and we're going to go try this new product, right? When you're a public company, you can't fuck around, right? And the way in which you communicate to the public markets, the way in which you manage your finances, the things that really, really, truly matter to the public markets, you're so maniacally focused on. It's a totally different business that you're managing and leading and running versus, hey, we're building a company to get there.
Unless you're Elon Musk, he can kind of do what he wants, right? He can say what he wants publicly.
He can. It's also because he's got enough money and he doesn't give a shit, right? But look, Aaron Levy had to grow to become a public company CEO. Anybody that has gone through that growth has had to learn what's involved in taking a company public, how to deal with Wall Street, how to deal with the analysts, how to deal with the haters on Twitter, right? Whatever it may be. The people that don't understand your business model.
Does that mean then that the people who only take it from 0 to 60, they don't commit to that same level of growth, and that's it? That's the list. What are some other? Is there anything else? Do they dream smaller? Maybe are their goals just not so outrageous? I'm just wondering if there's anything other than that, like investment in self.
Yeah, I think. I think you have got to be so totally invested in the customers that you're serving, right? And that has got to that has to win over everything else.
That's becoming more and more of a popular opinion. Yeah.
And your desire to become a better leader is actually driven by the customers that you're serving, and your desire to continue to serve them in a way that is better than you've ever done before. Eric Uni is a perfect example of this, right? We didn't know he was going to be a multi-billion-dollar, CEO. We certainly thought he could, but we also knew from, when you invest at Series A, when you've got $1 million in revenue, to going public when you're $100 million in revenue, usually at least, if not more, that's a ton of change, right? And evolution. But the one thing that is consistent with Eric, as he grew and developed, is he was maniacally focused on his customers' happiness from day one. And that's what drives him. And it continues to drive him today. And so he has an ethos about him, which is my customers come first. And I would argue Aaron Levy has a thirst for knowledge that he's trying to garner from his customers, and it's insatiable, and it drives him crazy. So he reads books and he meets with people, and he tweets all this, because you can just see his brain working in that regard, right? Those are just examples of people who went from hey, I'm just starting a company, to now I'm a public company CEO, and what's been driving them.
And what about what's still driving you after all these years? I mean, we were chatting offline, and you were just talking about how many miles you already put on, your freaking flyer program this year and stuff.
Yeah.
And I'm over here going, good grief, this guy's.
He also doesn't have kids.
I can barely get on a plane once every month.
Right.
Yeah, that's fair. That's fair. Yeah, we don't have kids. So that's fortunate. I have a wife that loves me
but there's
to be on
something,
the road.
There's something still driving you.
Of course.
This has been a really heavy week for a lot of people with the death of Kobe Bryant, and people I think are really reflecting and taking time to think about their legacy and their impact and what it all means. Are you at that stage of your life right now where you're thinking about those kind of things a lot?
I think so. For me, what drives me is kind of threefold. First and foremost, what drives me is my desire to be helpful. And in that is an element of giving back. I love what I do, because at the end of the day, I get to be helpful almost 24/7. Sometimes 24/7 is true, but being able to share what I've learned, what I've experienced, what I'm continuing to learn every single day is a total joy. Doing podcasts to me is so fun, because it's all right, cool. Let's talk about stuff that I've learned, or maybe things that I don't know that I'm really curious about. And for me, it's this just insatiable desire to continue to just be helpful, or to help other people. That's fulfilling to me. And where I get sidetracked is, anytime you're ever in a funk, this is for me, but also for most human beings, anytime you're ever in a funk and you just can't really get out of your own headspace, go help someone else.
Yeah.
Go help somebody else. And right then it'll remind you of your humanity. It'll remind you of what's important. And you'll be reminded of the joy that you feel when somebody else, has a deep-seated sense of gratitude and appreciation for you giving your time, money, resources, whatever it may be. And so to me, that really drives me. The other thing that really drives me is I'm also an insatiable learner. And in this role, because we invest in new companies every year, I'm constantly meeting new individuals with incredible ideas who are trying to change the world and change the way the world works. And that's super fascinating. So constantly being, mentally stimulated. Also, because the world of venture is new to me, and I've only been in it now for 3 years, I'm still learning a ton about what it actually means to be an investor, and how to pick companies, and how to provide help for companies where and when they may need it. And then I think the last thing is kind of to your point, is I don't feel like I haven't. So if this is here's where you can leave your legacy at the top of this arc, if you will, I'm not there yet. Mm-hmm. And so there's still something pushing me to go, what is this? If I wanted to be, what do I want to be remembered for? I feel like I'm not quite there yet.
Do you know what that is? You don't have to share it, but do you know what that place looks like? That precipice, or the achievement, or what you have left to do, or will you ever, is that a mythical place? Will it
Yeah,
just
yeah,
move?
that's it, dude. It's a great question, and we can pontificate about this. The journey is, it's not the destination, and this is not really a destination per se. It is the journey to get there. But I feel like there are definitely some bigger things on the horizon. It has nothing to do with leaving Emergence. I'm staying here until I'm deciding not to work anymore. But there's definitely some bigger things coming.
I resonate a lot with, just trying to kind of give back and help as many people as possible. One of the things that I struggle with is like figuring out who to say no to. I get questions all the time. Can you help me with this? Can you help me with that? And I would love to find a way to help everybody, but I can't. There's simply not enough time. And you mentioned earlier, like some of the Twitter haters or whatever, like I get hate mail sometimes on LinkedIn. I swear to God, I just got one yesterday. It's just like, somebody asked me for help, and I was like, sure, here's my calendar link, like see what you can find. And I would assume that they would book a meeting. They didn't book a meeting. What they did do is apparently they sent me an invitation to connect on LinkedIn. Well, I have like 2,000 of those I can't do anything with, and I didn't see it. Then I get hate mail that's like, you know what? Fuck you. You said that you wanted to help me. You don't even willing to connect with me. I'm not taking a call with somebody, right? So I'm at a place still where like those things affect me more than they should. One of the things I need to work on is how to just let go of that kind of thing. But how do you decide who to help? How do you decide who to say no to?
That's a great question. And first of all, anybody out there that's going to send hate mail for someone who can't actually create the time to help you, fuck off. Right. It's just, excuse my French, and I apologize for being so direct, but the reality is like, look, we're coming from a place where we want to be helpful, but we can't, right? And, we shouldn't be punished for that. My 2 cents.
Yeah.
We're going to do everything we possibly can, and things are going to come up, and we may say that we can help, and then next thing you know, we can't, and that's okay. It's part of just being human. Like things come up, and I guess the key is to not, first of all, not for any of us to not take it personally.
Yeah.
Right. And so especially if you're getting like people who are angry or upset with you, it's like for you personally to not try and take it personally, but also be like, hey, listen, just
also for that person.
I wish you.
Yeah,
for sure. But like, I would also wish that you would respect the fact that like I'm a human being and I'm spread really thin. And so maybe I'll learn from not saying yes to too many things. Maybe I shouldn't have said, yes, I'll be helpful to you. Maybe instead I'll say, I'll do my best. Let me know, let's see if we can work something out. And because in that way, you're not locking yourself into where you feel guilty, right? And you're not also setting up some false expectations to where they're expecting this and you're only able to get this. I think that's an important lesson for all of us. For me, good news is, given the fact that, what you and I do is largely very similar.
Yeah.
I have this umbrella of Emergence over me. So my first responsibility is to our portfolio company.
That's right. Yeah.
Right. So that's it. They take up all my time. And if I have the opportunity to do things outside of that, then I will do that. But it's kind of be stacked ranked in terms of what's being asked, what's my time requirements, and then like, could this potentially take me away from being able to do something else with one of our portfolio companies? These are all the things that I have to assess, right?
Yeah. Because
I have a fiduciary responsibility at the end of the day to my LPs, right, and to my GPs and to my portfolio company. So I kind of already have a hierarchy built for me, which is nice. Unfortunately for you, you've got your own natural hierarchy, which is whatever you decide, kind of finger in the air. And so it's easier for me to push back and be like, sorry, I can't, because I have other things going on.
What do you do outside of work? Like, I know you're passionate and you
surf.
Like, what do you do besides, work that
surf?
Get passion, that give you passion?
Surf.
Yeah, that's
surf.
it. How often are you surfing?
No. I do lots of other things. Besides surfing, I play tennis, I play soccer. I clearly have built a reputation of buying and remodeling houses and selling them not so much to flip, but just because I'm insane. I hate it now. It's like you know, I speak a lot of events, and it isn't so much just about, you know, it's not just for our portfolio companies. You know, I will gladly come speak at almost any conference, as long as there's not a conflict, because I love that. Is, to me, that is a gift. I can get up on stage in front of 10,000 people, no fear whatsoever, and walk out there and have a blast. I'm also a professionally trained actor, so I love it. So I'll do a lot of like one-off public speaking, storytelling, you know, core sales fundamental, brown bag training sessions all day, every day. I also advise a ton of little startups that are trying to get to the point where they can go raise money from us. So they're like, hey, I got this idea, where, you know, which direction should I go in? So I'll do that as much as I can. Kind of to Scott's point, I don't always have the capacity. Yeah. And if it starts to cringe on some of our companies, I kind of, you know, politely or respectfully say like, you know, yo, it's probably not a good idea because we've already made investments in these areas. And I'm not an idea stealer.
I got two quick questions for you, Doug.
Yeah,
one is fun, and one hopefully will educate the listeners. What's your favorite surf spot and surf trip that you've gone
on? I mean, my favorite first surf spot is Pleasure Point, because I haven't had a house down there. I go walk to
home base.
Five different breaks.
That's almost cheating. Your home break doesn't count.
That's a totally fair point. You know, I think, yeah, Uluwatu in Bali in Indonesia is like, you know, Canggu in Bali is, I mean, largely because the water's just ridiculously warm. The people are beautiful. The scenery is beautiful. The water's incredible. Like, yeah, sign me up.
I haven't got to Bali yet. Here's the last question that I want to ask. I get asked for advice all the time about stock options and equity and what it all means.
Whew.
Yeah. You know, the reality is, like, I would wager that 95% of employees who are given options of some sort don't have a freaking clue what they mean or what they're worth or anything like that.
Yep.
What is something that employees can do, should do to educate themselves and have a realistic picture of what they're stepping into? I had a conversation with a young lady not too long ago who had 500 options that she had been given, and the ruse was that she was going to be a millionaire after these. And I busted out a calculator and showed her, you know, what price per share they would have to be at some point in time in order for that to happen. And then I showed her the list of companies that I could find who had share prices that high, right? So can you give, you know, regular old early employees who are in this kind of stuff, like, what do they need to know, man?
Totally.
How do they prevent themselves from just getting oversold?
Sure. And again, this is my point of view, perspective. The first thing I will say is, a lot of people get really wrapped around the axle when it comes to equity, with this idea of dilution. Like, oh my gosh, we're going to go out and raise more money and I'm going to get diluted. And the truth is unless you own a percentage or more of the company, dilution doesn't really affect you. If you've got 500 shares or 5,000 shares or 50,000 shares, that's what you have. You're not losing those 50,000 shares. You're not going from 50,000 shares to 25,000 shares. So you have those number of shares. Now, granted, if you have a percent or 2 or 3 or 4 or 5% of the company and you raise money, then yeah, you're going to go from 5% to 4% to 3% to 2%. But you're going to have 2% of a $100 million company is worth a heck of a lot more than 5% of a $5 million company, right? So just one thing, just remember the fact that dilution as an individual contributor, even as a manager, even as a leader, unless you're at the executive level,
unless you're a senior executive, don't worry about dilution.
Don't worry about dilution, because people get really wrapped up on that. And they go like, no way, it's not going to be worth as much. The other thing that's important is, and I tell you what, I'll send you guys some links that you can send to all of your listeners, which can help you do a quick calculation as to what are my options worth. Because there are things that you need to understand of, like, you know, strike price, how much they were when you got hired. Was the stock at 25 cents or $1? right? You know, how many shares are outstanding? You know, like how much equity they plan to continue to put in the option pool as they go out and raise more money. So then your percentage, your 500 shares becomes a percentage of that. And it's a simple calculation. There's some websites that'll do it for you automatically. You just dump in the number of shares, you dump in the strike price, and boom, tells you what it's potentially worth. But at the end of the day, as an individual contributor, the best way to consider this when it comes to equity is like how many number of shares am I going to get? What is the conversion of those, which is typically it's over a 4-year period, right? And so it's like if I'm going to get 100,000 shares over the course of 4 years, it's 25,000 shares a year. The thing that's important to know is, should I buy them or should I wait until I fully invested them? If you feel like the company is like a rocket ship and you know they're going to go public or there's going to be a significant exit, then it makes sense to buy them. Buy them early, because there's a real tax implications for buying them early when the stock is, you bought them, you know, you were given the shares when the strike price was $1. They went out and raised money, and now the strike price is $5. You got a $4 gain. If you wait until the company goes public and they go public at $24, you now have a $23 gain. That's a huge tax bill you're gonna have to pay versus the $4 gain. But you also have to have some money in order to buy them. So just remember that there's some complexity around that. Right. And so, and honestly, I just wouldn't get wrapped up in anything other than the number of shares and what you think the company's, you know, value to the public markets might be. Like, how many people would consider Box almost $1 billion revenue company that is cash flow efficient, that is cash flow positive? I think they are again. And their stock price is $17. Nobody in their right mind thinks that that's realistic. When you look at Okta is $110, right? And so, like, who would have thought that? And you don't know. And the public markets are all wishy-washy.
I did. Right? I bought stock in Okta. I'm doing very well
that
there.
Was smart. That was super smart. But I tell you what, everybody that bought stock in Box were like, you guys suck. I've lost money. And I'm like, I know. Don't blame me. But, you know, like, so you never really know. And so here's the thing. The safe bet is, like, if you're getting your stock at less than $5, you got to bet that the stock, once it goes public, will be somewhere around 20. And do you have enough shares if it's a, you know, $15 to $20 gain to be something meaningful? Right. If you don't, then guess what? It's just a bonus.
Yeah. Right. Yep. Good advice. Good advice.
So this is sort of our last question. We sort of turn it around on our podcast, which is, you know, what can we do for Doug? How can we help you solve something big or little, whatever it is? Like, how can we be support to you? Because you've given us your time and your expertise and your knowledge, so we want to pay it forward back to you. Amen.
Pay it forward, pay it back. Look, first and foremost, I just ask that you guys keep doing what you're doing, because I love it, and I love what you're doing to the broader go-to-market community. I think one day you need to like think about this whole idea of surf and sales, because I think there's going to be a massive shift to revenue instead of just sales. And we're going to start to see a blurring of the lines of sales and customer success and account management. To be at the end of the, and even marketing for that matter, it's all going to be revenue.
You're already
it's already starting to happen. I've been talking about it for a year now. I've been working on a new book called Revenue Culture, like how to actually change the entire culture of your organization to be more revenue focused versus sales and product focused. I'm also working on another book right now, all on storytelling, called The Narrative, that's probably going to come out first, because I do so much work around storytelling and narrative building. And you know, so I mean, I'd say just if my only ask to you and your entire audience is just keep helping to elevate the whole profession in the world of revenue, and everybody on the go-to-market side, because we need it. You know, this world is only getting more complex. Yeah. You know, with the amount of products and information and everything that's happening, it's like, we need it.
Done. We'll definitely do that.
Definitely. Thank you, Doug, man. That was awesome. Really appreciate you coming on. And as always, a pleasure to see you. And
of course.
See you soon, Doug.
Of course. Look forward to it, guys. Thanks so much for having me.
Sure.
Bye-bye.